Good morning everyone, my name is Naesh Muhammad Saleh and my magic number is 01DPA10183. Alright, so today I will present to you all is about accounting process and book of accounts. So the first one is accounting process. The accounting process is a series of steps that business follow to record and manage their financial activity. It helps track money coming in and going out, ensuring that everything is organized and accurate. So the second one is book of account. Book of account refer to detailed record that business maintain to track financial transaction. So this record systematically organized to provide clear and accurate financial picture of the business operation. 5 important in business. So the first one is keeps track of money. Proper accounting help business know how much money is coming and going out. So the second one is meets legal requirement. So most businesses are legally required to keep prepared financial record. So next is help making decision. So good record help business owner make smart decision about spending, saving and growing money. So the fourth is good trust. Investor and banks rely on accurate records to record whether to invest in or lend to business. And the last one is prevent problem. Having organized account make it easier to spot mistake, waste or fraud. Alright, I will continue 4 steps in accounting process. Alright, the first one is identify transaction. This involves recognizing and recording all financial events or activity that affect the business, such as sale, purchase, payment, and receipt. These transactions are then documented with supporting evidence like invoice, receipt, and bank statement, ensuring that they are accurate and reflect the financial reality in the business. So the second one is recording in journal. This involves writing down each financial transaction in a journal using a system called double entry bookkeeping. Each transaction is recording with a debit and credit entry to ensure that accounting equation asset equal to liabilities plus equity stays balanced. So a journal serves as the first place where transactions are officially logged before being posted in the general ledger. The third one is posting to ledgers. Posting to ledgers is transferring journal entry amounts to individual accounts in the general ledger. So here a simple step-by-step breakdown. The first one is identify the journal entry. Find the transaction recorded in the journal. So the second one is choose the correct ledger account. Determine which account, example cash or account payable, should be updated. So the third is post the debit and credit. Transfer the amounts from the journal to the corresponding ledger account. Next, update to the account balance. Adjust the ledger balance to reflect the new transaction. And the last one is reference the entry. Add a reference number or note to link the ledger posted with the journal entry for tracking. Alright, so the fourth is trial balance. Preparing trial balance in the accounting cycle involves summarizing all ledger balance to check for accuracy. Here's a simple step-by-step process. First, list all ledger account. Gather all account from the general ledger. The second one is report account balance. Write down the debit or credit balance of each account. So the third one is total the debit and credit. Alright, add up all debit balance and all credit balance correctly. So the last one is check for errors. Ensure the total debit equal to the credit. If not, find and correct mistake.
Hello, my name is Sita Nubaya binti Omar Yusof and my matrix number is F1016. In this topic, I'm going to explain you the accruals and prepayment, bad debts, provision for doubtful and bad debt recovery, and lastly, explanation of depreciation of plants, property, and equipment. So after the trial balance has been drawn up, there must be adjustment that must be made to the balance found in trial balance. The balance of expenditure and revenue which are shown in trial balance, those of expenditure has been paid and the revenue where cash has been received. It have acquired expenses, prepaid expenses, acquired revenue and prepaid revenue. Prepaid expenses that will pay for in the current accounting period, but the goods or service will only be used in the following accounting period. Occur when the total expenses paid exceeds the amount that should have been paid. Must be deducted from the expense account. For prepaid revenue, money received in advance for service to be provided to the customer at later due. Create when the total revenue received exceeds the amount that should have been received. Must be deducted from the revenue account. And for accrued expenses that are not yet paid, even though the goods were received or service were used, occur when the total expenses paid are less than the amount that should have been paid must be added into the expenses account. Gross revenue is money not yet received, even though the service have been provided to the customer. Quote when the actual revenue received is less than the total that should have been received must be added to the revenue account. And for bad debts, debts that are unable to be collected from the customer due to customer debt, customer who are mentally incapacitated and cannot be traced. And for the second one, represent loss to a company and will be recorded as expenses, and it listed in debit side in trial balance. Bad debt recovery. Debts repaid by a customer after the debts have been written off as a bad debts represent an unexpected gain and are considered as a revenue and list in credit side in trial balance. For provision for doubtful debts and estimates of debts that are not expected to be collected in future counting periods. It's also only determined and adjusted after the trial balance is prepared. Defined depreciation is reduction of the value of non-current assets after being used in business operation. Cost of assets that are considered as expenses and list in debit side on in so it will reduce the net profit. Accumulate depreciation is amount of a non-current assets cost allocates to a particular accounting period. Usually accumulate from year to year and the book value of asset is at the net value of assets after deduction of cost and accumulation depreciation. Total depreciation is fixed and the amount is same for each accounting period. And scrap value is the selling price of the assets as a scrap at the end of its estimated useful life. Preparing financial statement have three steps, which is number one is preparation of statement of comprehensive income. Show the financial performance of the company, and the statement of comprehensive income should be have a heading which it includes three pieces of information, which is the name of business, the title of the statement, and lastly the time period covered by the statement. The body of statement comprehensive income consists of two main components, which is revenue items and expenses items. Step number 2, preparation of statement of financial position. Show the asset belonging to the company, its liabilities and equity at the year ends. The statement financial position should have a heading which includes three pieces of information, which is the name of a business, the title of the statement, and the given dates or a point in time covered by the statement. The body of statement comprehensive income consists two main components: assets, liabilities, and owner equity. And lastly, link between the statement of comprehensive income and statement of financial position. The statement of comprehensive income is the major link between two statements of financial position. The profit is added to the owner equity for successful operation, while the loss are deducted from the owner equity for unsuccessful operations. And lastly, for closing entries are used to close temporary account like revenue, expenses, drawing, and this reset the account to zero for the new period. And step in closing entries, which is close revenue as expenses, transfer to income summary, and after transfer to income summary, close the income summary and transfer to owner capital. After close drawings, transfer to owner capital also. So in a short, all temporary account are transferred to owner capitals. So that's all. So let's dive into book of account. So book of account have four categories: journal, ledger, cash book, and subsidiary book. So I'm gonna explain my part, which is journal. Journal is a sheet in which all transaction entries are recorded to chronological orders. Journal can be two categories: general journal and special journal. General journal is basic journal are record all business transactions that cannot be recorded in cash book. Meanwhile, special journal is used to record a specific type of transaction only. For example, purchase journal, sale journal, purchase return journal, sale return journal. Purchase journal is a list of record of all credits purchased for each period. It's also used for posting credits purchased to the purchase ledger. Sale journal is a list of record all credit sales for each period. Sale journal also used for posting credit sales to the sale ledger. Sale return journal or return inward journal is used to record goods returned to us from customer. For example, the reason customer returned goods to us such as goods were the wrong type, good were the wrong color, or good were faulty. Purchase return journal or return outward journal is used to record goods returned by us to our supplier. And lastly, general journal is used to record all business transactions that cannot be recorded in cash book or special journal. The transaction recorded in general journal are the purchase and sales of fixed assets on credit, the correction of errors, writing of bad debts, opening balance entries, drawing of goods, or increase in capital. So we have to put the list on general journal. The difference between special journal and general journal is special journal only have 3 columns, but general journal have 4 columns, which is date, particular column for debit and column for credits. So you can see example that I give.
My name is Nur Alisham Kabda Azmi. My number matrix is 01 DFI24 F1002. So I will continue about the ledger. Ledger refer to a financial record book where accounting transactions are recorded. Ledger also a book set of loose card or file that contain account. We have the 5 rules of ledger. The first one is recording and classifying transaction. The ledger systematically record all business transactions under specific account. The second one is providing a basis for financial statement. Information from ledger account is used to prepare essential financial record. The third one is ensuring accuracy and detecting error. The ledger help identify discrepancies and ensure that all financial transactions are correctly and record and balanced. The next one is monitoring financial performance. By tracking income, expenses, and financial position, business can assess their profitability and financial stability. The last one is supporting decision. Ledger account provide essential financial data for business planning and ensure compliance with accounting standard and tax regulation. We have the 3 types of ledger. The first one is sale ledger, purchase ledger, and general ledger. The next slide is example of ledger. Now I move to the second last of book of account, which is cash book. Cash book is a financial journal that records all business cash transactions. This fundamental accounting tool track both incoming and outgoing cash flows, providing business with real-time clarity about their cash position. A cash book is a primary book of account that chronologically record all cash and bank transactions. We have the 4 rules of cash book. The first one is monitoring cash flow. Monitoring cash flow track cash inflow and outflow, helping identify main income source and major expenses. The second one is ideal financial decision making. Ideal financial decision making provide reliable data to determine the right time for investment or cost cutting. The third one is preventing financial leakages. Preventing financial leakages ensure all transactions are recorded clearly, making audit and review easier. The last one is basis for financial reporting. Business for financial reporting provide essential data for financial report like income statement and cash flows report. So we have the 2 types of cash book. The first one is 2 column. 2 column consists of column for cash and bank only, but for 3 column consists of column for cash, bank, and discount. So now we move to the last one of book of account, which is subsidiary book. Subsidiary books are the books that record the transaction which are similar in nature in an orderly manner. They are also a special journal or their books. In big business institution, it is not easy to record all the transactions in one journal and post them into various accounts. We have the 5 rules of subsidiary book. The first one is classifying similar transaction. Classifying similar transaction organize transaction into different book. The second one is the workload on the general journal. Transactions are recorded separately, reducing clutter in the general journal. The third one is ensuring accuracy and reducing error. Minimize mistake and ensure correctly financial record. The next one is providing detailed financial information. Providing detailed financial information help track outstanding payment, returns, and purchase efficiently. The last one is facilitating faster posting to the ledger. This one is pick up the transfer of data to the general ledger and subsidiary ledger. So we have the 8 types of subsidiary book, which is cash book, purchase book, sale book, bill receivable book, journal purple, purchase return book, sale return book, and bill payable books. So, the next slide is example of subsidiary books. So, the conclusion of our presentation is the accounting process and book of account ensure accurate financial record by systematically recording and classifying transactions. This promotes transparency, accountability, and efficiency in financial reporting. Properly maintain subsidiary books and ledger help reduce error, organize transaction, and simplify financial statement preparation. This enable business to make informed decisions, comply with accounting standards, and track financial performance effectively. So that's all from us. Thank you.